kind of share a couple different things. I think the big thing that we're going to be focusing on is some of like the strategies around raising equity, specifically in relation to the folks that are going to leverage the SBA. So I'm going to probably talk a little bit more on the equity side, some different strategies we see people take as they're going through the search cycle, and then Matthias is going to be talking more from the SBA perspective. So I know you're going to do a full introduction, but if you want to say hi quick, Matthias.
Yeah, no, for sure. So super quick background. Mathias Smith with Pioneer Capital Advisory, based out of Madison, Wisconsin. So what my company does is we help business buyers go through the SBA financing process. So the problem that we solve for is you have thousands of banks that lend in the space, and you have $31 billion of deals getting done annually, both business acquisitions and all types of financing. And so when it comes time to having an LOI signed, the question is, where do you ultimately go to get the financing, and how do you do it as quickly as efficiently as possible? And so that's where we can plug in to help you as a business buyer ultimately solve that problem to move quickly and efficiently, to block and tackle through the process.
Fantastic. I appreciate it. Yeah, so we've been working with Matthias pretty closely, especially over the last couple of weeks and months. Especially as we have like changes with the SBA related to like how people are financing these deals, the capital partners they're bringing on. The reality is like each bank is looking at this from a little bit different of a lens, which is adding complications. So like being able to work with Matthias as he's like interfacing with all these banks all of a sudden becomes super helpful, right? I remember early days we got burned a handful of times, by working with specific banks that didn't really understand, the capital component, the preferred returns, and like how that was calculating ownership, and then, naturally that kills deals. And there's obviously a lot in flux as we've probably seen a lot from some of the changes that are happening that we'll discuss today. But for those that are not familiar with Ventures, we are located here in Austin. We actually started as a sell side business broker, transacted, probably 50 different small businesses representing the sell side. And over the last couple of years, what we've done is really started to focus on working with operators and buyers to help them, buy businesses. And we're specifically focused on how can we pull together the necessary capital. So like, great operators are able to transact. So, we took on some venture capital and really enabled to scale the team. We're probably about 40 people here in Austin. We've been able to syndicate and raise about, last year was about $16 million of equity, across a dozen or so deals. And there are kind of a growing network of people that want to participate, right? That I don't want to be an operator, but I'm really, infatuated by the asset class, and I want to be able to support operators. So the list is growing. We're probably at like 1,500 investors that are participating. I'm going to give kind of like a little bit of here. That's background on main shares, then with guys can kind of share what his team makeup looks like.
Yeah, no, and back to that last slide. So some of the deals, at least one of the deals in that last slide, Judd, Point B Communications was a client that we worked on mutually together. So just to give kudos back to the main shares folks. I mean, they do an absolutely phenomenal job. When you're raising equity for a first time, generally one of the biggest things is how do you, one, figure out what the market terms are that you should be offering to investors? How do you find the investors, and how do you do the pitch in an efficient way that's not super scattered? And so they really do a great job putting together a professionalized pitch and really positioning the deal in a way that's conducive to the market of investors, and doing a great job, with their data rooms and such. So just kudos to you guys for everything that you've done to build this.
Awesome. Thank you.
But yeah, so pivoting to this slide here, so this is kind of the composition of the Pioneer Capital Advisory team. So it's myself. So I started Pioneer Capital Advisory back in May of 2022. In the last 3 years, we've had the fortunate opportunity to work with 85 sponsors or buyers that have gone through the SBA financing process. So people buying everything from commercial roofing businesses to e-commerce, aphrodisiacs, sex chocolates, as well as that sounds, and everything across the board. And so basically what we do is we help business buyers with putting together the financing package that ultimately goes to banks to bid the deal out for financing to get term sheets. And then along the way, we basically we help with blocking and tackling various odds and ends as they come up, whether it be the bank looking to take a lien on your house when it has below 25% equity and it wasn't as collateral in the financing proposal, to the bank asking for a 10-year lease on your marketing company when it's not mission critical to operations. So this slide here just kind of gives a composition of the team at Pioneer. So it's myself. I've been in the SBA space going back for about a decade. Spent time at Live Oak Bank back in 2021. Worked there as a closer in their middle office, basically facilitating the deal process from approval through to closing. Valerie Sash on my team. She's based in Indianapolis. She has also been in the SBA space for about a decade. So we crossed paths at one of our former employers, Byline. She's kept very much involved in the blocking and tackling, super intricately involved from the time a deal goes into underwriting through closing. Then we have two inbound sales team members, Raphael and Alan. Raphael being based in Brazil, Alan's based in Monterrey, Mexico. And then three analysts, our director of credit, Pablo, based in Monterrey, Mexico, Fernanda, also based in Monterrey, and then Romero. And their backgrounds, respectively, are in private equity, have both normal private equity and real estate private equity, in addition to working in investment banking as well. So where they get involved is in the structuring of the deal to make sure it's going to pass muster from an SBA requirement standpoint, and then also helping to put together the bank deck that goes to bid the deal out to the market.
Yeah, good deal. Yeah, we've definitely enjoyed working with everyone included. So you guys are staying busy.
Yeah.
Okay, so from yeah, so sometimes people like ask me this, like, what are the reasons why people are raising capital? So, um, I think there's obviously like one component of like I don't have enough capital in order to buy the business that I'm looking for, right? If I buy a 250K or 500K EBITDA business, I'm fine, but like I'm really seeing like better opportunities, more structure, organization, a lot of value add if I go up market a little bit. So there's obviously components from that standpoint where if I can bring on some capital partners, I can really align to buy the deal that is best suited for myself. So we obviously see that from like kind of a gap equity standpoint. I would say a little bit more sophisticated of a buyer is going to think about it from like a risk perspective as well, and then also value add. So like as you think through, a lot of times they'll basically say, okay, I need 5% in, I need 10% in, and I have $100,000. That means I can buy X business, right? And $100,000 is going to basically put me into a position where I have $0 in the bank or enough to live on. So like there's an element of like if you're able to bring in capital partners, then you will have more close liquidity. It's definitely something from an SBA perspective that is getting harped on a lot more. And it's important to kind of think through where, if we go all in, and we're able to bring in some capital partners, we're going to be in a lot better position. If we need to inject a little bit more like cash into the business to operate as you're moving through transition. There's also a side of things where I think a lot of people are like over leveraging these deals, and every deal is a little bit different, but like they're maxing out all the models in order to barely get hit by the 1.15 DSCR. The pushback here is like, think about how long these businesses have been around. On average, like 20, 30 years is the deals that we're seeing. If you go look back at the cash flow and how many times it drops below that discount to coverage ratio, a lot of times when I ask for 5 years, 10 years, it's a third of the time, right? So like you almost have to assume that it's going to go underneath this threshold at some point, unless you're able to make absolutely zero mistakes, which, the 30-year operator, still may drop below that threshold. So like, I think people look at it of like, I want to create an extra buffer into this deal because I know inevitably things are going to go wrong. We're going to lose customers. We're going to gain customers. We're going to have to outlay costs. So thinking about it from a pure risk standpoint, I think is, where a lot of people come to us. And then, the
One thing
last,
just to
yeah,
pop in, sort of interrupt as well, is I think one huge benefit of raising capital for these SMB deals goes back to the philosophy of, do you want to own 100% of a smaller company that has more transitional risk specific to the owner, very much being most of the sales force and just overall kind of human capital infrastructure of the business. Say you're buying a 4 to 5 person business and you could own all the economic pie, but there's more risk. Or would you rather own a bigger piece, but not all of a bigger company, and still have majority control, but have less transition risk? So just to float that comment out there as well.
yeah, yeah, I think you're definitely right there. Um, and then I think the last reason a lot of people look at this is like they are, and this is something I'm very focused on. And for a little bit of context, I'm leading the capital markets team here. So like all the deals that we ultimately decide to partner on, that rolls kind of through the team I've built out. And then I overlay in a kind of investor growth, investor relations function. So I'm working with the people that have been allocating into deals, part of that $16 million, and then new folks coming in. One of the big things that we're always trying to do is like, you know, we're less intrigued on trying to find doctors, lawyers, people that just have cash. I think what's more interesting is like, can we attract, super successful business owners or, you know, investing professionals? Like we have a good amount of, private equity managing partners that have a robust experience on structuring deals. They probably have worked with operating partners and portfolio companies to help scale these companies. So like naturally, I think a lot of people look at it from the perspective of if I'm going to take on capital, I'm going to provide ownership for that capital. I also want that capital to be able to benefit the outcome of this acquisition. And that's probably like the last big point. But like as you're thinking about like, okay, what is my strategy? Am I going to need to be raise additional capital? I think a lot of the fundraising, and I've done some fundraising and worked with a lot of folks. The people that are the most successful, they're front loading a lot of this effort because the reality is when you go under contract, it's it might take you 12 months, 24 months, and then all of a sudden like that deal is you find the deal and this is the deal you're gonna gun after. You're quite busy, so it's like hard to then go and build relationships with people. Your window to raise capital is quite narrow. So I think of people that are really successful, they have front loaded this in that period when they're actually like searching for deals, right? So like it starts by what type of investors am I looking for, right? Are they value add? Are they passive? What type of sizes? What type of relationship, if they're going to be involved at all? Um, and then, there's interesting things I see a lot of people doing is like, one example of this is like kind of like a monthly newsletter, right? Here's my search. This is what I'm looking for. This is my thesis. As they're meeting investors, they're adding them to it. They're sending it out on a monthly basis. They're probably connecting with them to every couple months to be like, hey, here's what I've learned. Right. Originally, I was really interested in HVAC businesses, but I've found in my market, it's really predicated off of new construction. I just can't really get around that. So, I'm kind of pivot in this direction where I've evaluated this deal and these are the things I like and what I don't like. What it's effectively doing is like, you know, people invest in people, especially in this space, right? A good deal is quite critical, but the reality is the jockey is the difference maker in all of this. So being able to give someone a little bit of and start to vet and underwrite you as an operator is like quite critical. So then, obviously you're kind of starting to build out some reputation of, hey, I'm not just last week I decided I'm going to buy a business and here's a deal, invest here. I need $100,000 from you. So starting to build out that credibility and then having a structured process so that you're having like regular updates. I think the consistency is the most important thing. So I follow a bunch of searchers, newsletters, and updates. They're the first of every month or whatever cadence it looks like. And then I have, been very interested to hear what's going on. And it sounds like they have already kind of soft circled a bunch of the capital. We're obviously like helping a lot of these kind of components out, but I think it's helpful here. And okay, so now we kind of moving around to we have a deal. We already have these warm investors. These could be friends, family. One of the things I think is kind of critical, and the way I would relate it back to is like think about like the first conversation you had with the broker or the seller compared to where you're at today. It's going to be a very similar flow of pitching yourself, pitching a deal, figuring out how to navigate that, what kind of questions they're going to ask you so you have answers going forward. So I would say like this is the moment to be very prepared, and starting with like kind of more your friends and family to as you're going through the search is quite helpful so you kind of understand how to navigate the conversations. But from like a bare minimum, right, once you get a deal under contract, this is really where you want to dial in the materials that are ultimately going to be needed to assess the deal when you solicit investors. So what this looks like is, a teaser, a long form deck that can be as a follow up, and then a data room. And the data room is probably going to map pretty closely to the data room that you're going to send to Matthias and team for the SBA. There's definitely ways to like piece out the most important information, and then they can always request additional information after. Um, the the actual model forecasts and assumptions, that is basically backing up everything that you're saying in your deck and teaser, right? So as you think about here are my growth strategies, um, the model is backing up those figures so they can actually see, okay, if we're able to expand services, expand markets, we're able to buy more businesses, what is the outcome of this? And then from like a market term perspective, like having an understanding of what the market is requesting for deals is quite important. What I see happen pretty commonly is, you know, first time operator gets super aggressive on terms, and it is so far off to the point where they won't even consider looking at the deal. It's pretty common. You also have to realize like someone that's investing into this space can also invest into um, an independent sponsor group that's on their 20th deal, right? Significantly low risk. They've done 5 platform plays. They've returned 5x MOICs. So there's a little bit more of a risk investing into someone that's newer to this cycle. So generally, you're going to want to reflect that from a term standpoint. Something that we help out with quite a bit, and we're always constantly monitoring. So like as the interest rates are changing, that's going to impact the preferred returns, and we're trying to cycle that information back to folks raising capital. And then from like a process standpoint, um, you really want to have the entire flow mapped out, right? This is a sales cycle at the end of the day, right? So like, and the reality is like right, for us, for example, we see 50 deals a month. There's a lot of funds that we talk to that probably see even more than that. So there's always like new deals that are getting cycled to investors. So being able to have the clear path of here's the front end materials. Okay, now you're interested in that. We have the process to do any investor accreditations. Um, we have the process to actually sign commitment letters, subscription agreements. We've articulated when they should when closing is going to happen, so we can set up that first capital call and move the money over. Right. From our perspective, we've built out a tool to like handle this to ensure people are capitalizing on these great opportunities. But I do see it pretty common where a lot of folks will get a bunch of soft commits. Like I have the $1 million. Then when they come to have them sign agreements, there's a drop off. Then there's a little bit of a delay. Then people ask for the money, and now all of a sudden they're sitting at 600K of the $1 million. Right, and a lot of it is just like educating people through and gaining like commitments along the way. And the deal to investor fit, I think is quite important. Where people will ask me, should I should I provide cash flow distributions? Like my strategy is kind of like reinvest and grow. I think the big thing is you want to have your strategy of how you're going to repay investors and then align investors with that strategy versus trying to like map into what every investor is looking for because it's going to be quite different. So last component there from like types of investors that you're commonly going to see, like this does have an impact on the way you'll set these different deals up. But there are, I'd say a handful of funds that are investing directly into these vehicles. We're seeing a good amount of smaller family office participating as well. But one thing to call out, we did like a spike on, talking to minority co-invest and family offices, about 100 over a couple months. You'll see it on their website that it's like minimum 2 million EBITDA check. I would definitely tap into how many of those they've done. What we found is for some of these shops, happened one time 10 years ago, and they just don't do it too frequently. So it is something to like really like hone in on if that's the direction you're looking to go. We see more of these deals getting done, occasionally with like kind of a lead investor, a fund that's doing $500,000 to $1 million checks, and then a lot of it's coming from individual investors and friends and family as well. So this is just like a quick visual. I'm not going to go over this in like full in depth, but I think it gives kind of an idea, and we're going to send this out after of kind of the sequencing of each of these timelines from the seller, the lender, investor, kind of internal perspective as you're moving towards close. I would say starting conversations early as possible with capital partners, especially on the equity side, is quite critical. I think a lot of people will wait until diligence is completely done, term sheets, maybe like you're close to having a commitment letter, and now they think, okay, we can turn on these conversations with investors, and in the course of like 3 weeks we can raise the money. It's like highly unlikely unless those people have already said, hey, we're going to do it, we just need to see a good deal. And even at that case, this is where I see people really struggling. And this is also kind of like, the connotation that like if you have a good deal, there'll be capital. I generally think that's true, but if the timing is so narrow, that usually breaks that thesis. So starting the conversations earlier, letting them know, hey, we're going through diligence right now, sharing those findings with them allows them to be kind of along for the journey and understand how you're thinking about navigating it. Okay, like we found something out in diligence, we're going to have to go restructure this because the concentration of this customers is too high. We looked at the contracts, and the contracts are going to expire, and they're going to have to renew 3 months into us buying this business. Like we can't take that risk on. And it's also very interesting, but I think people that do this, and when they're letting their investors know and then they turn the deal away, it creates a tremendous amount of confidence that it's that you really care about finding the correct deal and you're aligned with the outcome for them as well. All right. Also, if you have questions or anything, feel free to fire them in. I think a lot of people probably are aware from some of the terminology here, but the big thing is common ownership is generally provided to management teams, operators. Preferred equity is going to be provided to investors. The idea here is for a lot of these deals, investors are providing a majority of the equity risk in this. So the way that this is set up is we're going to pay back investors first with additional free cash flow in order to de-risk their position. This also then kind of comes with a preferred return where we're going to give them a set amount of probably 10 to 12% rate on their invested capital, and then we're going to return their capital. And I would say from a timeline standpoint, for a lot of these SBA size deals, you'll want to be able to return capital with real, like very reasonable growth projections in under 4 years. Otherwise, it gets there's just better deals out there that will return capital faster. And then you're using distributions from the business to actually provide capital back. And then I'll share the step up a little bit more in a second. And the last is, from I would say market perspective, we're seeing a lot of deals that are clearing pretty quickly, are sitting about a 2x step up. The IRRs, generally above a 30% IRR. based off of like the risk associated with these businesses. And then if you account for an exit, on a 7-year basis, it's probably a 3 to 5x multiple on invested capital. So I put in 100,000, 5x multiple, you'd be returning 500K to that person. All right. Okay, so I think this is one of the last slides here, but for those, I would say the preferred participating equity with the step up is the most common approach to structuring an equity deal for SBA size transactions. So the way that this works is, first investors are going to get the 10 to 12% preferred return, right? So you're effectively repaying that 10% before you start paying the principal back. This generally accrues over time as well. So there's an incentive to actually provide that. You usually want to see this, most investors want to see this above, if the SBA note is at 9%, they're going to want to see 10%. It aligns incentives to pay back investors. Then you're going to be paying back the outstanding 100K that was invested, and then they participate in the upside. So the way that the step up works is it effectively helps account for how much leverage is put on these businesses. So say $1 million deal, you raise $100,000. If you were to provide 10% ownership, it just wouldn't be attractive enough for how much risk and leverage is being put on the business. So what the step up does is it kind of sweetens the position a little bit, but it also is still providing a majority ownership to the operator, which has been deemed as market. So the 100,000 times 2 converts to 200,000 over $1 million. 20% would be going to investors after they've returned capital and got their 10% return. And this should all model out to that 30 plus IRR, which is, these are passive investors. They generally get like limited shareholder rights. So day-to-day operations and control are all still provided to operators, which makes this like incredibly attractive. You go up market, it's significantly less economics to the operator. So people are usually happy about this.
Yeah, and one comment just to sprinkle in there, Judd, my understanding, just to kind of ask a rhetorical question, it's the personal guarantee the operator signs. That's why they get so much of the ownership.
Yeah, that definitely has like an impact for sure, because it's almost viewed as like capital coming to the table, and then the leverage is why there's like a step up as well. But yeah, those are kind of both hand in hand of how like the market is deemed that risk, and for that risk they are then providing majority ownership to the operator. So yeah, that's spot on. Okay, Daniel. One sec, I might have to unmute you. Albina, if you know how to unmute Daniel, he's trying to ask a question.
Or even type in the chat. They're all disabled. I was hoping you could maybe I don't want to belabor it, but the step up, I wouldn't mind if getting a little bit more detail. Maybe if you've got an Excel spreadsheet that could show us how it works out, that would be super helpful. Just to make sure I understand the mechanics.
Yeah, we can share one after as well. But what specifically is?
What I would be wanting to do is just look at how it impacts IRR. So whenever you do a deal, you want to be able that step up flows through properly to the whole deal. And I'm not sure I quite understand 100% the mechanics, because it doesn't look like carry.
Okay.
It looks like between.
Yeah, so effectively what this is, if you're thinking about it from the carry perspective, is in this scenario, there's an 80% carry to the operator. Which is obviously like flipped on its head with most of, private equity style deals would be 20% carry to the operator. So effectively how this is, it's like a 2-tier waterfall. First tier is we're going to repay back invested capital plus the preferred return as a baseline. It's kind of like a hurdle rate. Then after that happens, there's going to be a split between the invested capital and the operator. And in this scenario, 80% is going to go to the operator, 20% is going to go to investors until exit or until there's like a buyout or something along those lines. So when you think about this and you think about return profiles, the purchase price that you ultimately pay for the business has a pretty high impact on what this is. If it's 1.7, if it's 1.5, if it's 2.5, because effectively what's happening is the more that you pay for the business above like the market rate, what that's saying is you need to grow the business faster in order to have the same return profiles if I would have paid one turn less. So for that risk, I'm going to request more ownership in the business. And this also works vice versa, where it's like, if you pay, most HVAC business trades at 4x multiple for $1 million. You pay 3x. Now, to get the same return profiles, if I kind of risk adjusted it, you wouldn't really need to grow much or grow at all, and I could have the same 30% IRR returns. Or I might not request that much ownership in the business, and that step up is gonna go down. So this is something we work with people a lot on as they're putting in offers, just to understand, okay, like if we really want this business and we're gonna pay more for it, the outcome is a little bit less ownership in the business, effectively, because someone has to take on that risk, and for the most part, it's gonna be the operator giving up ownership. Is that a little bit helpful?
So basically, the investor owns 10% of the equity but gets 20% of the returns. Is that what you're saying by the 2x step up?
Yep, after they've gotten their 100K back.
And that's a no catch up 100K, I guess, right? The 100K and their preferred return, there's a no catch up clause there.
No.
Or how does that work? Because a preferred return typically in a private equity fund is you have a catch up for then the private equity investor to get whole at some point to the preferred return.
Yeah, basically what the pref and Judd might do a better job explaining this than me, Daniel, is like, say you invest 100,000 in a deal and the pref is 10%. It's like the 10% is just accruing on 100,000 while the pref is outstanding. And so whatever point in time you're buying out the investors, you're basically paying on the 100,000 plus the accrued, if that helps.
Yeah.
Okay. Appreciate it. Thank you.
Yeah.
And Daniel, the way that a lot of these deals are set up is obviously the operator is going to be putting in some personal capital. Effectively they're getting the same economic, right? So the actual ownership dilution is more impactful. Say if you put in 20K and you raised 500,000, your 20K times 2 versus the 500 times 2, there's obviously more of a dilution impact. But if you needed to raise 500K in total, you put 250K in, investors raise 250, both is getting stepped up into that position, and it ends up being a little bit less dilutive. But you are getting effectively the same terms as invested investors as well. So, which enables people to start getting distributions before they have paid down all of the capital that's invested. Okay.
Thank you.
On the distribution side, yeah, of course. And then on the distribution side, there are some dependencies around mandatory distributions with the SBA. We do generally see like the most common time period is probably after the first year is when conversations start happening. Really, a lot of people want to be able to stabilize the business. They want to understand if there's cyclicality in the cash flow, and once they have a better scope on how much cash is needed to really operate, is when they would start using excess cash. So how that usually looks is like, okay, after the end of the first year, we know that at all times we probably want $500,000 to operate this business. we ended the year, we're at 750K. Let's do a 250K profit distribution. And we'll distribute that back to start paying down investors. It is kind of the most common timing that we see, unless people come in, and have a lot of excess cash off the bat. But first year is seemingly a common approach. And then I think the last piece to call out is we do see a lot of call and put options. The call option is probably the more common one and more agreeable with the SBA. What that's saying and the way that this is priced out in the valuation is predetermined. But what it says is at a certain point in time in the future or at a certain return profile, it could be after investors get a 3 times return on their capital, I can start using cash flow from the business to start buying out their position so I can retain 100% ownership. So we do see that pretty common. A lot of investors are actually, they like to see these clauses because at the end of the day, they don't want to be stuck into a private illiquid asset forever, right? So for the people that are I'm going to buy and I'm going to hold this company and I don't plan on really selling it, it could be a nice mechanism to provide them liquidity and then provide full ownership back to the operator after a set period of time. All right. It looks like we got some questions. If you want to drop any of them into the chat as well, happy to answer them. Or
one comment just to kind of sprinkle in here, as it pertains more to the SBA financing side. So if you buy the business using SBA financing or otherwise, you can actually use a subsequent SBA loan to buy out your investors. So sometimes people I've seen come back and do that.
How about I think we have a couple more questions. I'll circle them in the end, but I want to make sure Mathias can talk about some of the SBA changes as well, because it's definitely relevant as people are gearing up mid-cycle on deals or they're starting to put in some new offers. So I'm gonna kick this over to you. Start talking through some of the SBA considerations and tell us some stories give us the war room.
Yeah, no, for sure. So there are some recent SBA cap changes that are coming to place effective June 1st, specific to the new guidelines. So one of the biggest changes as it pertains specifically to equity investors and deals is before March 7th of this year, basically you could have 51% of the cap table or ownership group in a business owned by US citizens or green card holders, and the other 49% could be owned by non-citizens, non-green card holders. But on March 7th, the SBA put what's called procedural notice into place to essentially require that all of the investors in a deal are now citizens or green card holders. So that's just one thing to kind of be mindful of if you're going down the path of raising capital from investors, is that now basically the bank requires them to self-certify and sometimes provide documentation to actually validate their residency status. So right now I have a deal that we just had a closing kickoff call for, and the bank is actually asking for the passports for the investors to verify that they're citizens. So some other kind of big guideline changes that have gone to place. One kind of that pertains specifically to the second item here is on the down payment documentation. So under the current SBA guidelines, which sunset June 1st, banks basically had the option for what they wanted to require as far as down payment documentation. So some banks might have required no bank statements, others may have required 1 or 2 months. But now kind of all across the board, the new guidelines require that the bank shows where the funds were in the accounts that are contributing capital to the deal. Going back, it's either 1 to 2 months after, I think this might be right, 2 months prior to the date of closing. So one thing that I've told sponsors to do, especially when they have investors that are kind of cagey and or high net worth, of not wanting to provide the bank statements, is to issue the capital call earlier in the process so that you basically have those funds sitting in the acquisition company account, and that way basically the bank just needs to collect that single bank statement, and you don't have to go to your whole cap table to have every single person at the cap table providing bank statements. One other thing too is, Kev, as far as the down payment documentation or down payment guidelines go, is with the new guidelines, essentially, you either have to have the whole down payment come from cash from the sponsored investors, or you can basically have half of it come from a full standby seller's note that's basically has no payments for the full duration of the SBA loan term, and the other half can come from cash from the buyer and investors. So there's now going to be more than a need for investors investing in these deals. So kind of parlaying back to one of Judd's earlier comments about what's market for terms in the space, my personal thought and thesis is that now more than ever, given the demand there's going to be for investor capital, the terms on the margin might become richer from the investor side. So if you're raising capital in this space, you really want to make sure that you're actually offering market terms and talking with folks like Judd at Mainsures to make sure that when you go out and you pitch investors, you're not being too aggressive as a sponsor, because investors are going to have a lot more at bats than they did going back prior to June 1st. I think on this slide, I'm good. We could go to the next one.
Yep.
So the first point there, Kev, on the 10% equity injection, that's essentially, Kev, effective June 1st, the down payment either all needs to come from cash or a combination of cash and seller financing on the full standby. Let me just look at this question here from James. Can you speak to how investors cause issues during the SBA process beyond what's already been mentioned? I would say, James, so one thing is, so back to the documentation specifically that the bank needs, that's kind of one way I've seen issues getting caused. The bigger thing is, like, the bank needs to know who's going to be in the cap table, specifically the ownership group, at the point in time that they go into the SBA system to pull the loan authorization, get the SBA approval. So on the sponsor side, the sooner that you know who the investors are going to be, which typically happens in underwriting, that is kind of the first item in the sequence of events to actually determine who needs to who needs to be in the SBA system. Let me just get through the slide and I'll go through the rest of the questions here. So 20% from a common equity standpoint is what triggers the need to be a personal guarantor or signer on the loan. So most investors typically in the space, due to that SBA provision or requirement, won't own more than 19% ownership. And so generally that's why you see the sponsor or the operator having majority of control of the business to avoid having investors personally guarantee the loan. I've worked on hundreds of deals outside of Pioneer before starting this. I've never once in my life seen an investor personally guarantee a loan. So it's just completely off market and non-market. On the multi-step or phase buyouts no longer being allowed. Basically, before there was a way to do so before the SBA guidelines changed, there was kind of more nuance as to how you could do multi-stage acquisitions, which are no longer allowed under the new guidelines. Candidly speaking, I need to read more into that provision to speak intelligently to that. So we can skip over that.
Yeah, I would say the one thing that on the number 2 point, right? So like what we were seeing was by rolling equity from the seller, it was enabling individuals to get a little bit more aggressive on their offer, right? Because you roll 10%, 15% equity from the seller, and then you put 10% in. Now you have delevered the deal a little bit. And naturally, you're going to be able to have a higher purchase price and offer to go forward with. So this does, like, inevitably hurt individual buyers as they are trying to think about creative ways to align incentives, get the outcome that the owner is looking for, and then provide some of that upside. So it is going to have to, like, there's a handful of deals we're working on now, kind of going back to the drawing board about how to actually do this. Obviously, earnouts are kind of off the table. So um, in order to be competitive, my guess is that equity, if you need 25% in order to get to that purchase price, that's going to have to come from new capital and new investors in the front end. So we're starting to see that as well, where if you there's only a certain amount, like a purchase price you can go at if you're at 95% leverage, 90% SBA, 5% seller finance, 5% in. There's kind of like a max multiple that you can pay for that business before your coverage ratio is a little bit too low for the bank to say yes. So my guess is people will start raising a little bit more equity in order to get competitive on these deals. Obviously, the market is challenging right now. So that's kind of my guess of what we've seen already and how people are thinking about it.
Yeah, it looks like we had a couple of questions here. So Paul is asking, is the personal guarantee triggered based on project cost or percent of your own contribution? So the answer there, Paul, is basically it's based on what percent of the ownership group or the cap table you're in as the investor. So 20% is the threshold specifically that would require the personal guarantee.
Let me just add just a separate, because I think even with main shares, I have had a separate answer. So for example, if let's say the purchase price is $1 million and you're putting in $100,000. Well, let's say the 10% of $100,000. So let's say if you raise 50 and you put in 50, that's, if you go based on proportionality, it's 50-50. So PG is triggered for that one investor. Or are we saying that, let's say your 10% is $100,000 out of the $1 million, right? And then the investor provides 50% of the 100,000. So his PG isn't triggered because it's 50,000 out of the 1 million. And so that's what I'm trying to clarify.
Yeah. So this is, I would say from my perspective, a little bit, can be a little bit frustrating. What I've seen is a kind of a smorgasbord of the way that lenders are calculating beneficial ownership, right? So, because there is a preferred return, there's preferred equity, there's preference of when that money comes to, when it's paid out. So like we have like a model that we've used in order to kind of show the different ways of ownership and how the preferred return impacts the total amount that's distributed back to investors. But I have had conversations with some banks that are like less familiar with how preferred participating equity works, and have told me, if you give a 15% preferred return, that's 15% ownership. Therefore, the max that they could invest would be, 5% of the equity. And like naturally, that doesn't make any sense. So there's like some education that goes into there, but this is also having someone like Mathias to kind of work through, like, it's not even just the bank, it's working through one of the BDOs that has experience with preferred equity. Like we've had challenges in the past with the same banks and different BDOs, which I think that's one of the reasons why, we definitely recommend working with like a loan broker like Mathias, because we've even seen variability with inside the same banks that you guys are all probably chatting with. So
I mean,
it's not a great answer, but it is like something that is challenging.
Last thing I'll say is there, I know Live Oak provides like a calculator. I mean, they're super conservative, so that it sucks, right? But they're just one bank. So if you guys have like some sort of a spreadsheet that actually aligns to what, let's say, the majority is, let's say not, and you can exclude Live Oak probably from this calculation, and so that we have a good understanding of when is PG tripped, and I think that'd be very helpful if you guys can send it out in addition to the slides.
Yeah, we're happy to. I think it's definitely like having the conversation of, hey, this is the way that we're thinking about what would trigger the PG. Are we aligned on this? And then probably even showing, kind of like the model that we have to be helpful. I think it's with a lot of this, it's over communicating, right? Letting them know that investors are going to be involved. is helpful. Otherwise, sometimes we've had situations where, operator was indecisive on if he wanted to raise capital, didn't really need to, ultimately decided to, didn't notify the bank. Bank's like, we need to go through the entire underwriting again, and then was, held up the deal for like another month. So I think like communicating how you're thinking about this and getting buy-in that, you're not going to be triggering the personal guarantee, and you kind of have that max check size mapped out. And, we're always like, if you're working with us, we jump on calls and we kind of walk them through this. So there's a little bit of education that we've been doing as well to help people get over the line here.
Yeah, I would agree, Judd, with the comment about different lenders within the same bank having more or less familiarity with these like search fund equity raise deals. So like anecdotally, well, I have to be careful calling specific banks. So I'm working currently on a deal with a top 10 SBA bank that's newer to the search fund equity raise type space, but they've done lots of transactions, over 500 million in originations. And so now they're trying to get their arms around just how the model works. And so I think really kind of understanding, if you're an investor in the deal, has the lender specifically at the bank worked on these types of deals where they can kind of relay back to the back office, essentially the model and how it works to kind of thread the needle on any asks for documentation and just being able to kind of socialize the deal dynamics with the closer and with the analyst underwriting the deal makes a world of difference, honestly.
Okay, I got a question from Bram. So if there's a call option from the operator to buy out the investor, what is the typical valuation basis or formula used for that buyout? What I think we see quite commonly is going to be a multiple on EBITDA. So it could be this would be like pre-decided up front. You buy at a 4x multiple. Maybe you're going to add in a half a turn on this, and this is generally pre-negotiated. Alternatively, what we do see is relatively common is kind of a third-party valuation shop coming in. The fairest way to do this would be having two different valuation companies coming in, and then meeting in the middle on what that is. Because the reality is like you can definitely find valuation shops that are going to come in low, some are coming high. In outlining the methodology that's going to be leveraged as well, if that's discounted cash flow. But a lot of times this is going to be predetermined, and I've seen both. Hey, we're going to get a valuation shop that's kind of punting it out into the future, but we've decided what groups and who's actually can request that, if it's both parties or if it's just the operator. And alternatively, kind of a cleaner way is just to determine it based off of a multiple of EBITDA at the point in time. And if the seller note is structured to match the full life of the SBA, can it still count towards the required 10% equity for SBA eligibility? Mathias?
Yeah, so if the seller's note, so it would be on full standby or payments being made.
Yeah, I think that's the determination if it's on full standby.
Yeah.
If it's payments are being made, then no, right?
Yeah, if it's on full standby under the new guidelines, then it can count towards up to half of the down payment.
Do we have any final questions? I know we're about to be wrapping up. And Mathias, do you want to wrap up with any of the last couple slides? I know you have a few, but
yeah, sorry, I was just reading some of these questions coming through here. Yeah, so Bram, the answer to the question, so but not 100% of the down payment. So the seller's note now, the SBA basically caps the full standby being able to be half of the 10% down. It used to be able to be as much as the bank would allow it to be, and now that's gone away effective June 1st. So yeah, let's see here. So we covered this slide, Judd. Let's go to the next one. So this is just kind of a high level overview of the Pioneer process. So basically we would kick off with the engagement letter at the start of the process. So we typically get involved in deals at the point in time that the buyer is under LOI or kind of close to that point. So they have a signed IOI or something, basically memorializing the deal structure. So the engagement letter would basically explain, we will be building a deal deck for them. We'll help with putting their deal, and for the banks that we have high conviction in, can get it done with the best credit terms. And then once that deal deck, I think the slides may have gone away there. Oh, you're sharing your, there we go.
Sorry.
You're good, Judd. So once that engagement letter gets signed, we would send an intake list to you as the prospective client of everything that we would need to kick off the process. So that'd be the financials for the business that you're buying, last 3 years of business tax returns, current year-to-date interims, a prior year financial statement broken out monthly, so that the analyst building the deck can do a trailing 12-month or LTM comparison, showing year-to-year financial performance. And then from you as the sponsor, the buyer, we would collect your SBA personal financial statement, something showing your current credit score, so that we can position your buyer profile in the best light possible to the SBA banks to help you get the best credit terms that we can. A resume or CV from you, and then your last 3 years of personal tax returns. Once we have all of those items in our virtual data room, within 2 business days, we would have the lender deck for your deal prepared. We would then validate with you the cash flow model of that deck, as well as the source and use portion of the model, to get your thumbs up and validation that matches your expectations. And then we would take your deal out to market to the banks that we think it would be a good fit for, based on industry, stability of earnings. Is it a project-based revenue company, like a contractor, versus a recurring revenue company? What percent of SBA financing are you looking for relative to total transaction value or total use of funds? And then also, how is the down payment capitalized? So is it coming from yourself plus investors, or a combination of full standby seller financing and cash? And so typically it takes a handful of business days to get term sheets. You would basically decide which one ultimately you would want to engage with. And then once you have the term sheet kept picked that you want to engage, but before you ultimately head into underwriting, the bank would need from you a 3-year financial projection with the first year broken monthly in a business plan. And so we have templates that we would send to you, or you could engage a third-party provider to build it if you wanted to. And then once you have all of those, basically the underwriting process would kick off. To get from the start of underwriting to approval, typically I'm seeing it take between 3 to 4 weeks, depending on the complexity of the deal. And then things like, does the bank need the final cap table prior to approval? And then Valerie, I might say, my chief operating officer, would basically be involved from the start of underwriting through to closing, to help with blocking and tackling alongside the bank. And so our average time frame from the start of underwriting to closing, kind of wires going out, is about 74 days on average across 85 deals that we've closed. Yeah, this is just the intake list mentioned previously. It looks like we have a couple of questions coming in here. Okay, so I got asked a question. It was sent directly to me, so I won't mention necessarily who sent it. So the question is regarding underwriting the sponsor buyer profile that you underwrite. Would a buyer operator who has debt, negative net worth, be a deal breaker or not? The answer there is, it honestly really depends. I've only seen 1 or 2 deals, I think, get done with negative net worth sponsors. And in that circumstance, basically, it was people coming out of an MBA, like top MBA program, where there's a lot of capitalization within the actual deal itself. And essentially, it was primarily student loans as the reason for the negative net worth. If it's someone carrying lots of personal debt, I think that would have changed the calculation. It certainly makes it a lot more challenging than someone that has a lot of money. This last slide here, pretty self-explanatory. This just kind of covers the time frame going from start to finish through the process. And so generally by the time we're about a week into engagement, if we have everything needed, the deal is getting put in front of banks, and then 30 days to 3 weeks to 30 days in underwriting, and then the last month or so post approval, purchase agreement, down payment documentation, things of that nature.
Fantastic. Do you have any more? Yeah, there we go. Well, great. Just to kind of wrap up, thank you, Mathias. That's fantastic, and I hope people enjoyed this as well. I would say like key takeaways here is like the people I see getting deals done are they're very flexible and they're able to like navigate these changes, or they're working with really solid partners like Mathias, working with us to be able to like figure out different ways to raise capital. If that's from individuals, or they go larger checks, they're restructuring the deals, and they're relaying that information. So I think there are a lot of changes that are happening right now. So if you're kind of set in stone, this is I have X amount of money. This is the one approach I'm going to do. It becomes really hard to actually pull off an acquisition with this landscape. With you have competitive forces, a lot of buyers coming in, you have SBA changes. You obviously have like varying deal quality and challenges within deals that really dictate what lenders will even be interested in the first place. So we're happy to help. We'll send out a recording. We'll send out the deck. Make sure Mathias can get in contact with you if you have any questions. So we'll get in contact information for everyone. And if there are follow-up questions, feel free to drop them into kind of the message that we'll shoot out after. And we're happy to, sure, either of us schedule time or answer them offline. So anything else you want to add, Mathias?
Yeah, nothing else. I mean, for anyone listening that wants to connect, feel free to shoot me a LinkedIn message, or shoot me an email to Mathias at pioneercap.com. We always hop on, honestly, Zoom calls with people across the whole life cycle of the buying process, from pre-LOI, early stage searchers, so people that have 100,000 of liquid capital or more in a good resume. We'll do what's called a financial letter of support to basically kind of help them as they go to market and they're talking to business brokers to give credibility. And then on that document, it has an addendum referencing some of the transactions or deals that we've closed, just to give some credence and support as well. But if anyone has SBA questions, feel free to shoot me a LinkedIn DM or shoot me an email. Always glad to help.
Okay, perfect. Thank you, y'all. Have a great rest of your week.
Awesome.